Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have George Cipolloni. He is portfolio manager at Penn Mutual Asset Management to discuss if the markets have gotten ahead of the Fed. George, it's great to have you with us at MarketSite for the first time. And fortuitous that it's also Wednesday, Fed Day, when we're going to get either a rate hike, how much, what the posture looks like with the Fed. With the strong performance we saw in January, do you think the markets are ahead of the Fed?
Yeah, first of all, thank you for having me. So happy to be here in person. So absolutely. So the market has gotten way ahead of the Fed. The clearest way to see that is in the financial conditions index, and it's really shot up since October. So for the past 3 months now, the market has gotten way ahead. One of the reasons why it did, though, is because a lot of the inflation metrics that they know the Fed is going to track have softened. And so, again, that gave them kind of free will to just go ahead and increase valuations across stocks, bonds, and yields in general have come down.
What's the likelihood of a recession this year?
So I think it's a lot easier to project for us. We are bottom-up analysts. It's a lot easier to project an earnings recession coming up versus an economic. But to your point, so we have so many mixed signals across the board. On one hand, we have an inverted yield curve, a very, very inverted yield curve. That typically implies that there will be a recession. We've seen other economic indicators come in that are weak, like the LEI indicators. We've also seen some other things that are showing some weakness. On the other hand, we've seen the exact opposite. The NEBR stats are not saying that there's a recession yet. And credit spreads, for example, in the high yield market have not indicated a recession yet. So again, we are in this situation where there is still the potential, I think, for a soft landing. But there's also the potential still for a hard landing if things don't go as well as the market is hoping.
So do you think the Fed's going to maintain its posture?
I think they should. So right now, given that move in the financial conditions index, it's really a benefit for Powell and the Fed. It's given them a lot of wiggle room to make changes to policy or to stay the course. So there is more room today versus back in October when the markets were getting hit pretty good. So they have wiggle room. I think they should, because the element that's coming back into the markets from '01 is a little bit of the frothiness and a little bit of the speculation that we've seen in January. And you don't want that to get out of control again like it did in 2001.
So tell me more about your investment process as it relates to stock selection and asset allocation, because you brought up a really good point that maybe not an economic recession, but an earnings recession, and that's an important distinction to make.
It certainly is. And so if you think about the markets overall, so we are bottom-up investors. We can absolutely pay attention to every top-down observation we can, but in order to have a good, repeatable process, we think we can do that a lot better from the bottom up. So we focus on valuations as one component, the potential for sales growth is another, and the potential for margins expansion is the third. And if you focus on those three key factors, you can add a lot of value within a flexible investment process, which is what we have. And so, for example, our stocks in our portfolio were up over 10% last year, which is a lot different than the rest of the market. Our whole fund was down 4% because bonds were also down, but our category was down about 13 to 14% versus our down 4%. But again, going back to it, if you're able to identify good companies, good management teams, and good balance sheets, you can add value in just about any market. So that's why we do focus on the bottom up versus the top down. Again, it's just more repeatable, more sustainable, and it's a lot more flexible from our value perspective.
Right, and 2022, yes, it was a volatile year, but I also think it was very valuable in terms of understanding those lessons and why balance sheet and corporate teams are so important, because we kind of got away from that a little bit. So when you think about the market from a technical and fundamental perspective,
yes.
How do you feel about it? Isolating the economics, but the market itself.
Certainly. So to your point, technicals look outstanding right now, and the market absolutely ripped from October. If you look at January's numbers, the Nasdaq was up a ton, and if you look at some other, high yield bonds did really, really well. I think investment grade bonds did as well as it's done since 1977. So you're seeing some really good, strong underlying performance. The technicals look great because, especially in the fixed income market, there's just not enough supply of good credits out there. And so anytime a bond comes to market, it gets bought up pretty good. So the technicals are important. And you see valuations go up. Unfortunately, that can't continue for too long until they get fundamental confirmation. So valuations can keep increasing, but if earnings keep decreasing, that's going to be an anchor that's going to hold it back at some point.
Right. So I guess the question is, will financial reality hit the market at some point?
I think it will ultimately. So I think there is a small segment or a generation of the market that kind of grew up in 2021 and they got super excited by the speculative aspect. the more gambling aspect of the markets, and that's not financial reality. Financial reality is again, good companies, good earnings, good margins, and we will get there. The other big thing is this hurdle rate now. So this may be the first time in 40 years that interest rates may finish or may come in higher than the pre-recession level. That's a pretty big difference, and that creates a higher hurdle rate and a higher cost of capital that's going to be maintained, and that ultimately will lead to financial reality.
All right, George, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.